Alibaba is the biggest e-commerce platform in China. However, the stock price has been falling with the US elections, as Trump said he's going to increase tariffs on Chinese imports even further. Another reason for Chinese stocks falling is because the Chinese stimulus plan has been a bit of a letdown. Alibaba is a company that has a market cap of $217 billion that did 130 in revenue in the last 12 months. Of that, 9.5 was profit, which puts them at a P of 25. However, the forward PE is 10 because net income is expected to recover, which we'll see later. Financially, their revenue has grown from 500 billion yuans 5 years ago to 950 currently, which is $130 billion. Their free cash flow has been a bit more inconsistent, but is currently sitting at 126 billion yuans. And their net income took a hit in 2021 and hasn't really recovered since then, and is currently at 70 billions or $9.5 billion. One thing that I love about this company is the number of shares outstanding, which has been decreasing. The company has been buying back shares, and this is very positive for investors as you get more ownership of the company. Also, their margins took a hit in 2021. As you can see, their free cash flow margin was between 25 and 30% and has been around 10 to 15% over the past 5 years. And their profit margin took an even bigger hit and has been around 8% in the past 4 years. But even with this drop in margins, they are currently selling at a forward PE of 10, price to free cash flow of 12, and price to sales of 1.7, which is cheap. And analysts are expecting them to keep growing as they are expecting them to grow revenue at around 8% annually for the next 3 years, and EPS is expected to recover nicely, growing 100% this year, which is why the forward PE is 10. But in order to take an even deeper look at the valuation, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to it is between $95 per share and $271, and the stock is currently selling around $91 per share. Moreover, this means that if the low assumptions occur, you're going to make around 11% annual return on your money, middle 21.5%, and high 33%. By the way, these returns include the dividend, which currently has a 1% yield. I believe my assumptions are reasonable, as I have the company growing 4% annually on my low assumptions, 6% on the middle, and 8% on the high, averaging a profit margin and free cash flow margin of 12, 17, and 23%, and I assigned a PE and price to free cash flow at the end of the 7 years of 14, 16, and 18, and I left the share outstanding change the same. However, they have been buying back shares, and if we assume they buy back 2% of their shares annually for the next 7 years, the valuation becomes even more attractive. Moreover, Alibaba has a fantastic balance sheet with $61 billion in cash and only 33 in debt. I want to disclose that Alibaba is one of my biggest positions in my portfolio, and I am currently up 21%. And if the stock price continues to fall, I would like to buy more shares. They are reporting earnings on Friday, and I think we can conclude that Alibaba stock has dropped because of macroeconomic concerns about China and not because of their fundamentals, which have been getting better and are expected to get better. There are obviously some risks in investing in Chinese company, but I believe that the pros outweigh the cons. I hope you found this video valuable. Let me know what you think about Baba in the comments, and I'll see you in the next one.